Good evening, everyone. I'm Nidhisha, Vice President Market Insights at HSBC India, and would like to warmly welcome for today's call. Today's topic is aptly titled Unravelling the Indian Growth Story. Before we welcome today's esteemed speaker, I would like to set the context for the theme. Recently, India crossed the 4 trillion mark in GDP, and the writing seems pretty clear on the wall. India seems to be witnessing probably the Goldilocks moment despite the global uncertainties. However, whether this euphoria is temporary and misguided, or actually a prelude to a long lasting transformative phase which catapults India among the leading world economies, is something that yet to be seen. To dissect and understand this better, we have with us our expert speaker. With this, I warmly like to welcome Mr. Neelesh Surana, CIO at Mirae Asset Management Company. Mr. Neelesh Surana is the Chief Investment Officer at Mirae and has joined Mirae in 2008. In his capacity as CIO, he spearheads the research and fund management function. An engineering graduate with MBA in finance, he has over 3 decades of experience in equity research and portfolio management. I would hereby warmly like to welcome Mr. Neelesh, post which we'll have the Q&A sessions wherein you can post your questions to him. Over to you, Mr. Neelesh.
Yeah, thanks, Nidhi, for inviting me, and good evening to you and your clients. Thanks for the introduction. As you had said the agenda, we'll talk about what's happening in the global environment and amongst the global chaos, why Indian economy is fairly resilient, and that's sort of reflected in the stability of the equity markets. So what I would do is there is a structured presentation. Some of the slides I would sort of refer, and we will talk about global macros and also the strength of Indian economy, why Indian macros are pretty holding on, and would also sort of look at from the lens of medium-term trend over the next 2-3 years, what are the trends taking place in the economy, which are the sectors which would sort of drive the growth. And as well as we'll take a more 10,000 feet view and look at the longer term trends. Is that intact in terms of why the Indian economy, when we say you alluded to $3.74 trillion and moving to 6.5 and eventually to 10 trillion, what's sort of driving that? And subsequently touch on the markets, which is a function of earnings, flows, sentiments, and valuation. So all that we'll sort of try to cover it in say 15-20 minutes. And we can have more interactive session after that. This is just a scorecard in terms of all of us who are sort of tracking the markets. That I think as we are completing this calendar year, the highlight has been the strength in the broader markets. When I say broader market, I'm referring to not the top large cap Nifty companies, but the mid caps and the small caps. And there has been unusual strength, particularly those who are following it since March of this year. And as you can see, they are up almost 35-40%. The index itself and many stocks are up meaningfully higher. Even at a Nifty level, markets have sort of done well at around 9% sort of growth in the context of what the global environment is. And only one macro, which is obviously the most important one, we'd like to sort of talk about, is over the course of last almost 20 months, we have seen one of the steepest interest rate increase globally. Even in the last almost 65-70 years, this sort of pace of increase has not happened. And if you look at US interest rates, literally from 0.25 at north of 5%, very significant increase. Of course, in India, it increased by about 250 basis points, 2.5 percentage points. But across the world, we have seen the interest rates moving up is a function of two things. One is post the global crisis, post 2008, for various reasons, the interest rates were kept artificially low because both central banks were sort of putting money in the system. And post COVID, when we saw the inflation move significantly up, and to curb that, particularly in US, uh, the Fed had to increase the rate disproportionately. That is the crux of it. Within inflation, the services inflation was very sticky. The point here is there are a couple of things I would like to sort of comment because it's a very complex topic, not making any call on what interest rates are headed. One is that 2 years back, not many would have anticipated that US Fed rates will go north of 5%. So a large part of shock is already done. That is one. And that's also a function that inflation also, large part of it is already done. And it's been, given the resilience of the Indian market, it's been fairly an unanticipated event, and change of era or a regime change in interest rate has taken place. And a significant part is already known, what was unanticipated 2 years back. The Bloomberg consensus, in fact, 2 years back anticipated first hike in 2024. So that's the pace of surprise that sort of happened over the last 2 years. The second thing is Indian macros are slightly different. Our inflation is not sort of sticky. So our interest rate is linked to one of the parameters is global US rates, but not necessarily because of that. It's more linked to inflation. And the third point here is the differential between US and India interest rates has reduced significantly. What used to be on almost 3.5%, 4% or more than that has come significantly. In this context, what we see is obviously with the rising interest rate and there is talk of recession, whether it is soft lending or hard lending, that time would say. And all economies, there is a degrowth reset, particularly in calendar year 23. We see that Indian economy and the latest IMF number for the last few quarters, clearly India is an outlier. It will continue to grow at closer to 6.5%, 6.5%, potentially touch 7% also. And that is one of the factors which is holding on to the markets. And we'll touch on that both on the medium term factors and the longer term factors, why there is a confidence on this 6.5% plus real growth. Just one point on this interest rate. I mean, what I missed earlier is it is not necessarily that when the interest rate increases, the markets don't do well. It's also a function of when we are, where we are in the economy in the cycle. I mean, if we are closer to trough and there is a mean reversion happening in certain sectors, is very different than if we are cyclically sort of high. Again, on the same point, just to conclude on this interest rate inflation view, is that in India, if you see the inflation has now stabilized. The latest number, if you look at RBI classifies something called core inflation, which is X of food and X of fuel, because food is very volatile and fuel is divided. We are prone to volatility in oil prices because we import 85%. And that has come to almost 43-month low. So RBI's estimate itself for next year, same time inflation is in the range of 4.5%, 5%. That would mean that a large chunk of interest rate increase in India, which was partially driven by what's happening globally, is sort of should stabilize and should be supportive. The policy environment should be supportive over the next few quarters. Of course, India inflation also moved up because of what happened in Ukraine war and recently the geopolitical issues which we have been seeing, and that also has been a bit supportive. In this context, where we have seen over the last 3 years, I mean, we of course initially the stability post-COVID, COVID itself, and then we had the shock of interest rate. As I said, it's a regime change. It's a change which is it would stay at higher for longer. What level? One can't comment. But definitely artificially low interest rate, which the world has seen over the last 15 years, is unlikely to sort of we go back to that sort of regime or era. And of course, there were wars and volatility in commodity prices. In this context, if you look at our what is called high frequency indicators, means the larger indicators, let's show how the economy is doing. Let's measure it. So let's say GST collection, which is indirect tax collection. So it's growing at almost high teens. Or e-way bill, again, which shows the momentum in the economy. On a 3-year basis, is again going in high teens. Or if you look at personal credit, it's again growing it closer to 18-20%. So most indicator, barring two things. One is recently what's happening in the global economy, so IT sector, and the rural or low income cohort, those sort of things, which is yet to stabilize. Most large or high frequency sort of indicators are showing fairly strong and stable sort of environment despite the headwinds. When we use the word chaos, it was global interest rate, earlier COVID, and volatility in commodity prices because of geopolitical factors, etc. So why is this strength in the economy is coming? I mean, I will just call out some important 4 or 5 trends, more from the lens of markets, but also in terms of what's sort of happening in the economy. And then we'll run through the longer term drivers. And I think there are some important and interesting trends which have been taking place recently. First and foremost is India's manufacturing push. Our share of manufacturing in GDP. We have, let's say, manufacturing, agriculture, and services. That's a component of the GDP. The share of manufacturing is very low at around 15%. More importantly, India's share of uh, merchandise good export is literally half of its share in the GDP. So if we represent 4% of global GDP, our representation of merchandise goods export is less than 2%. So we have not done well as a country over the last few decades in manufacturing. We do believe that it's now or never for India manufacturing to take off. And this is not 1-2 year theme. Actually, it has accelerated recently, but it would take time for it to get traction, and it could last for a few decades. And as we have seen in various economies, starting from US, Southeast Asian economies, we saw in China, even Vietnam, or Korea from 1982 to 2000, manufacturing moved from 14 to 30%. We are exactly at similar point, 14-15%. And there are 3-4 reasons for that. First is, as most of you would have heard, there is a China plus one. Purchasing managers would like to de-risk the purchasing from China because of what happened over the last 5 years, trade wars, COVID. I mean, you don't know what happens to Taiwan and China sort of relationship, geopolitical issues, etc. So those who have been sourcing, say, 80, 90, 100%, for example, Apple iPhone sourcing was literally 100%, 90, 95%. So they would like to de-risk. So that opportunity is called China plus one. Now, whether it goes to India or somewhere else, and that right to win depends on the individual country's ability to get that opportunity, which could be roughly about $300 to $400 billion. And so that is the element of that. That is first point. Second is we have a right to win because our structural positive of competitive manufacturing wages, and our dollar wages have been fairly competitive. This country has enough and more supply of skilled labor. We need to provide literally 80-90 lakhs jobs per annum for the next 10 years every year. So that much employment is sort of available. And that makes it very competitive in a world where we don't have so much of skilled labors, particularly obviously in the developed markets, even in some of the smaller markets. And third is government push towards the PLI, which is the incentives they give to accelerate manufacturing exports. And we have seen fruits of that. For example, in mobile, we have seen Apple exports increasing, or manufacturing sort of increasing from literally almost zilch $1 billion to north of almost $5-6 billion. And that may look big, but the denominator is very big in terms of what they are doing in China. That is north of $130-140 billion. So even if 10-15% shift, it's a very large one. And the last point why India manufacturing should happen, particularly in consumer products, is also that we are the few countries where you can also make in India for India and also for the world, particularly for consumer goods like mobiles, etc. You have a population of $1.4 billion, which can also be sort of serviced, which we can't say for smaller countries. So that's first point. And I think it's a very long-term trend. It may take a bit of time, subject to execution, but there are evidence of success in certain pockets. Going into detail of the PLI, but that is first point. Just one point along with manufacturing is also that the services export has also picked up significantly in last 3 years. And I'm not referring to IT traditional services, I'm referring to more business outsourcing. And there is a concept called Global Capability Center, GCCs, which is MNCs. They set up their center in India, whether it is Hyderabad, Pune, or any other location. And post-COVID, they outsource various things in-house. It's their own sort of requirements. And post-COVID, multiple services they have realized could be outsourced, whether it is taxation, whether it is back office, and a lot of other things apart from IT services. And the GCC's number the recently is about say 1,500 and growing, out of which 500 have come in last 3 years. So that also is accelerating. So both on services and manufacturing, we have new drivers to sort of grow. The second important uh, trend which is holding and sort of helping the economy, is the downturn in the housing sector has been arrested. This is third year of uptrend, and this can be seen from lower inventory. Unsold inventory in 2017-18 was about 7.7 crore homes, which has now come down to 1.5 crore. Despite the increase in interest rate, affordability and absorption is decent. Of course, there is a structural demand drivers, but also the entire construct post-COVID, I think it's giving a lot of stability. And housing is a very large sector. It supports 70, 80 businesses, almost directly, indirectly, 2.5, 3 crore jobs. A lot of large sectors are linked to theirs. It goes, I mean, let's say cement, steel, building materials, of course, financial services, etc. sort of is linked to growth in housing. So there is a turnaround after a decade in terms of residential thing, and these are long duration sort of cycle. A third thing is, which I think is not doing well, but could probably stabilize, is rural or the low income. And that's because the construction migrant work has come back. So the remittance, the rural is not only about agriculture. A typical rural household would have someone working in a city and doing some construction work, etc. So that got hit by COVID, that has stabilized. And with government thrust on infrastructure, that is helping. Second is inflation, what we touched upon. I think the worst is over. So that would sort of help. Third is because of election season and the large election next year and a lot of 5 elections, state elections. And now there's a lot of government support which would happen, and overall farm income are sort of reasonably okay. So I think all put together, and most important is the base itself is favorable. So this entire thing that say two-wheeler is not doing well, two-wheeler sales are lower than 20-25% of the previous peak in 2019, whereas four-wheelers, high-end is doing well. Rural high-end goods are doing well. A Titan is doing well, whereas Bata is not doing well. Something like that, or staples are not doing well. I think this K-shape in India, what we have been using the term over the last 2 years, and there are signs of it to sort of stabilize, although not concrete, but over time, because of low base and all these factors, should help revive the rural economy. The fourth point is corporate India. When we say is in good shape, it is leverage is at 10 to 15-year low, and banking balance sheet is very solid. In fact, all the balance sheet, government balance sheet, corporate balance sheet, banking balance sheet, and even consumer balance sheet has been fairly benign compared to what we have seen over the last 2 decades. The last point, and in terms of medium-term trend, is I would like to say is more qualitative, is what has happened in the economies over the last 4-5 years. A lot of shocks have taken place, starting from demonetization. Then we have the GST stuff. Then we had COVID. Then we have volatility of raw material, a lot of compliance, digital infrastructure. So in that context, consolidation and formalization of economy has taken place. So if in the last 12 years, the GDP has grown by 3.8 times, the tax collection has grown much higher. And in last 5 years, particularly, a lot of consolidation has taken place in larger sectors as well as smaller sectors, particularly where unorganized is very high. Let's say if you look at footwear or building material, the sector is very large, but the listed companies or the bigger ones are relatively less. And there are a lot of unorganized players. And they have been struggling because you can't I mean, tax compliance has been very strong. Digitization has helped, and all these external shocks have made it very vulnerable for weak player to survive. So strong has become stronger and weak has got marginalized. And by strong, I would say largely it is listed companies, top 500, top 1000 companies. And this has some connotation, those who would invest in market on mid caps. I think the relevance of mid caps and small cap is also high because many of those companies have become much bigger, courtesy the consolidation which is sort of taking place. So I think these are, say, about 5, 6 factors I wanted to call out from the medium term trend. And just coming to the market sort of outlook, not going too much in the sort of detailed, is that earnings growth have been fairly stable, and this is Bloomberg consensus number. We anchor to 1100 earnings. We are around 17.518 times FY 25 number, which is what we would look at after a couple of months, 1 year forward number. The in context of all these development, as I said, the earnings growth has been reverted, and the PAT to GDP also is at a decadal high at 4.7%. And the growth in earnings has been driven by mean reversion in many sectors, banking, uh, uh, most of the financial services. We have seen it in healthcare. We have seen it, yet to see it in some cohort of urban or low-end consumption, but high-end consumption, we have seen a lot of mean reversion, in fact, pent-up demand, etc., sort of coming in, and that has helped the growth, along with margin reversal, which was impacted last year by war and the commodity prices. Markets are also a function of flows, and the interesting thing here, which all of us would know, is what has changed over the last few years in Indian economy is the advent of SIP, the popularity of SIP, which has literally doubled in last 3 years. We are getting almost 16,000 crores per month, very large number. So if you look at the trend, I mean, from October 21 to June of 22, FIA sold literally 2 lakh crore, and the selling actually did happen all the way up to March 23. So such a large selling in the range of almost 2 to 2.5 lakh crore, and in the context the interest rate move up, the markets have been fairly resilient. And one of the reason was the domestic flows have been very strong. And domestic flows can be is largely comprised of, let's say, 50% or about 1,50,000 crores come from mutual funds, and most of it is coming in a manner which is very systematic because of the SIP. So it's not driven by lumpy. It's not lumpy. It's very systematic. It's regular, and it's a large number to that. In addition to that, you have insurance flows. You have flows from PMS, individual sort of investors, and obviously FIA flows are also there. So the overall flow bucket is fairly solid, and within that, the complementary SIP flows of mutual fund is something which was not there 5, 6 years back. If you imagine 2 lakh crore of selling by FIs over a period of 12 to 18 months, 5 years back or 7 years back, the markets would have corrected significantly. But now we have a steady flow of almost 16,000 crores only by SIP and not including lump sum. And I think a lot of new investors, a lot of folios have come post-COVID. And as the experience, if you look at SIP returns have been now pretty okay, pretty decent. As the experience is satisfactory, then the concept of wealth creation by investing from a lens of 3 year, 5 year, or probably 10 year plus in a systematic way can only accelerate from here because the percentage of equities within household is still a long way to go. Just to a big picture, I'll sort of just 5 minutes on this is Nidhi started that from 4 trillion to 6.5, 7, and then eventually 10 trillion. Now, why we should grow? I think there are few factors which are structural, longer term factor, and it's important for investors to have confidence in those factors because macros can be volatile, but the foundation of these factors would help India to sustain growth. And this is mainly driven by the demographic. We have one of the most favorable demographic in terms of median age being around 28, would remain same at the end of this decade. Also, the dependency ratio, the number of people working, is very favorable all the way up to 2050. Then we have age cohorts in terms of younger population, and as the people move to working age cohort, then obviously you earn more, save more, spend more. So obviously there's a growth. There's a urbanization trend of almost 0.5% a decade or so. People are moving from rural to urban, and that has large implications on economic activity. And of course, in general, because the per capita income, we are at around $2,400, is low. As it improves, then people tend to spend not on necessary items, but on many discretionary items, which in turn spurs economic growth. And then the advent of digital economy, gig economy. So all these and more women in workforce, qualification of media, all that the aspiration level is very high, can be linked to this entire demographics, which apart from the scale of the population, is the underlying trends, which is very, very positive from a couple of decades point of view. Second foundation of growth has been the infrastructure, because countries devoid of infrastructure, and there is an government national infrastructure plan. I talked about housing revival. So government is doing heavy lifting of infrastructure in various cities, railways, roads, ports, airports. All a lot of momentum is taking place, both by central government, state government, and public sector undertaking. Second is household capex also is solid in terms of revival. So I think that is good help in sort of supporting the growth, and there is a need housing for longer term. All this is we have not included manufacturing exports and services export will also help, and also the productivity gain arising from all these infrastructure benefit. And this is also very well lubricated by huge reforms which this country has taken place in last 5-6 years, definitely last decade. And various reforms are talked about. We can talk about the digital reforms. We can talk about the physical reforms. And among the digital reforms, it is now all of us know about it, is the identity Aadhaar thing, which started, and what the revolution it has done. Incremental 70 crores and an account has happened. So what we thought that India would remain, banking penetration would improve over 3-4 decades, happened within a decade. So the identity part, the payment part, the logistics part has been taken care by huge successful mission of Aadhaar in case of payment UPI, which was launched, I think, in 2016. So in less than 8 years, it's a case history that case study that now there are almost 900 crore transactions a month. There are 30 crore people using UPI. There are 5 crore plus merchant on the POS sort of system. Not the POS system, but on the UPI sort of thing. So I think it's a massive change. In fact, we are much ahead globally. And that has helping in the sort of productivity. So all these put together do give confidence of growth around 6.5 plus minus 0.5% or 6 to 7%. I'll skip the investment part. We can touch in the Q&A. And just to sort of conclude, if you look at the longer term trends in the equities, and it tends to give returns slightly more than the nominal GDP growth. The near term trends could lead to volatility, and longer term it tends to go in terms of the nominal GDP growth. So if you look at 6.5% growth, so we are talking of nominal GDP growth of 11 to 12%, which means that all else being same, say returns should be around doubling of the money in say 6 years time, which is 12%. So I think in a low inflation regime, 12% return is pretty sort of solid. And I would just sort of pause here and to on the just to conclude, what does it mean for market? I would say, because there's obvious question, if the market move too fast too soon, what should one do, lump sum? So I would conclude with three things. One is overall view to a lens to invest is very constructive, given where the Indian economy is headed, given the structural drivers from medium to longer term perspective. And that's also that a large part of valuations is sort of reasonable. So there could be some part of valuation which is high. So what we are saying is three things. One is stay positive with the first is have a 3 to 5 year time frame, which is always there in equities, but more so now. When valuations are not dirt cheap, they're reasonable. Second is keep the expectations low. When we are living in a lower inflation regime over a longer period of time, expectation should be lower of returns. So say about 12 to 14%, low teens should be the expectation. If you get more, it's a bit of bonus. Uh, and third is, at this point in time, the best is to invest in a staggered manner. So if these three things are done, then I think investors will not be sort of disappointed. And the amount of wealth which has been generated in the past, despite macro headwinds, because over the last next decade or so, we're unlikely to have all these once in century, once in decade sort of disturbances which we saw. I think the returns should be fairly decent. With that, I would sort of just pause and pass on to Nidhi. Thank you.
Thank you so much, Nilesh sir, for this lowdown on how India looks, how it's staggered, and how it's placed for the future, this thing. And also the sanguine tone with a little bit of caution in the end. That was definitely welcome to understand it better. We have been getting a lot of questions, so I'll kind of, move ahead with the questions that we have received. So this is something that we get to hear very often, and it seems to be something that every time you have the market run up. So while we do understand, do need the mid and small caps in your portfolio, and you also need the large caps in terms of adding stability. But at this point in time, where do you really see in terms of valuations or in terms of future prospect? How do you really stack up the large caps as compared to the mid and small caps? If you could add on that.
Sure. So if you see the first slide, which I showed that the large cap index, which is the Nifty index, has generated about 8-9% return. The mid caps have moved by 30-35%. And but in prior to that, of course, there was correction in mid caps much more. That said, in terms of fundamental sort of valuation, we see more value today in terms of risk-adjusted return in large and in fact giant caps, the larger companies. They are reasonably priced. Of course, you have to go stock specific, but in general, the category is reasonably priced and we see a better risk reward there. Unlike other markets in India, large caps also have good growth potential. So one should have about half to two-third allocation in large caps, otherwise also. The only point, Nidhi, I would like to mention, which I was not saying it, let's say a decade back or 5-7 years back, that the importance of mid and small cap has increased in last 5-7 years, and definitely over the last decade, because a lot of new businesses have got listed, existing businesses have got meaningful, and the slide which I showed on the formalization trend and consolidation trend is advantage many of those businesses. See, large cap, the number of slots are fixed at 100 companies. So not all companies can be. So the largest footwear company, largest tile company, largest diagnostic company, hospital company is unlikely to become a large cap because 100 slots are generally with BFSI, oil companies, consumer companies, the old IT companies, etc. So that means if you want a proper color across businesses, then the importance of mid cap is there. And this has happened even in last 5 years and 10 years was not there. A lot of new listing, new companies, existing businesses become bigger, and this consolidation, which is moving from unorganized to organized at that. So I would say from a template perspective, longer term, and this is, of course, there are experts to advise, then one should have about 50% in large cap, 30% in mid caps, 20 in small cap over time. Today, there could be additional 10%, 15% more in large cap instead of 50% at the expense of the small and mid caps. That's tactical, but longer term, given the volatility, etc., about 50 to 65% should be in large caps.
Okay. Thank you so much for that. I'll move ahead to the next question. As I mentioned, there are a lot of them. So during each and every movement in the markets, you see some sectors emerging as favorites. So definitely I'll move on to the PSU, which has really garnered a lot of interest. But BFSI is something that has been really with temporary blips in between. They have really been like the favorites throughout this entire movement. So anything specific? You did mention about the digital payments and how banking is spreading across rural economy, etc. But any few key takeaways that is kind of driving this entire growth in the BFSI, or something that's really the main tailwind for the sector?
Yeah. So one is, see, in India is underserved of credit. So first of all, the credit growth will be higher than the nominal GDP growth. And when you are saying that the economy itself will double in, say, 6.5, 7 years time frame, so this is a growth sector because one is the growth in the economy and the under penetration. In addition, you rightly mentioned more on BFSI rather than only pure bank. So a lot has changed in the sector over the last 5, 7 years. I talked about new listing. So now that sector includes many different businesses, not necessarily core lending businesses. It includes insurance, it includes wealth management, it includes asset management, it includes distribution, it includes fintechs. So, and a lot other sort of gamut of businesses are coming in, particularly when you look at a BFSI fund or BFSI theme rather than pure sort of banking. And within each of these cohorts, again, we are seeing strong is getting stronger. The top 5, 10, 5, 7 names are getting much stronger in terms of their business internals, be it liability franchise, lending franchise. So I think if India has to do well, obviously BFSI has to do well and consumption has to do well. There are certain theme sector, obviously, on which the foundation is sort of built. And so to that extent, it's very interesting sort of space. And by the way, it's coincident that some of the large caps in the banking space is one of the pockets which has not moved as much. Let's say large private banks have not participated as much as the many small second tier government banks or many other small caps in different sector other than banks.
Okay, thank you so much. Uh, uh, so we talked a lot about, what is going to drive the GDP, the sectors you mentioned. You mentioned about the high frequency data. But what could you really perceive as, some key risk that could kind of derail this growth story in the near term or, in the near term future as well?
Sure. So one is a bit of perpetual risk that we as an economy are dependent on oil, and that dependency is in fact unfortunately increased till the time EV takes larger proportion. So almost 87, 85% is oil. So anything, see, we're not so much dependent, many businesses and aggregate profitability is so much dependent on global event. But if oil were to go higher, maybe artificially because of supply disruption, geopolitics, then it impacts on multiple macros, balance of payment, ability to pay forex, current account, interest rate, inflation. All that gets sort of impact, particularly it is not the base case scenario. We're not basing that because globally EV penetration is increasing, but it's more to do with cartel, supply side, geopolitics. So that is one risk, which is that if oil were to settle, I'm not saying it would, but if it were to settle in 3 digits or so, for medium term also, for short term also. That's one. Second is near term. We started talking about the interest rate, its impact. We don't know what could be the delayed or the backdoor sort of impact because government debt to GDP in US and all is increased significantly. Is literally since World War II, the debt to GDP is now similar level at around 125% or more of GDP. So when the interest rate increase is significant, which has happened recently uh, over the last 1.5 years in US, to service that debt, they have to pay a lot of interest, and that could lead to complications and recessions there. So if there is a hard landing, India is not totally dealing. There could be an impact on IT and otherwise also on goods, services, exports. So that's a factor which one has to sort of track. I think these are two sort of risks. And of course, there are elections, so there will be talks of that, but I don't think that could have a significant sort of impact. Last risk, if I were to say, is there are certain pockets in the markets, particularly in small caps, not the entire basket, which have moved too fast too soon. So the starting point of valuation is not favorable. So it's not a risk related to economy and earnings, etc. Is this if you're buying dollar for $1.50, then your starting point is not good. So you'll have to wait. Either there will be time correction or price correction or both. But that is more to do with the section of small caps, which are more flavored of the season sort of sectors, not for the overall market.
Thank you so much for bringing that point. In fact, it kind of leads to the next question that we have. So when we see this kind of a phase when there is a lot of euphoria about new age companies, growth from small and mid cap, it brings back to the tested question that we always kind of evaluate the growth style investing and the value style investing. So if you could really kind of talk about in current light, or how as a CIO you kind of balancing between the two, because you cannot ignore the growth companies as well, because you need to really stack up well in terms of performance, but there has to be some wisdom as well. So if you could just
Sure.
talk about that.
Sure. So in the institutional template, obviously, what is, see, buying a stock is like starting your business or buying a business, ready business, someone else is running it. So at the end of the day, there is a value. Now the business can be a high growth or can be moderate growth. It doesn't make sense to buy in India a business which is low growth, no matter what the valuation is. But you have to pay a rational price for a high growth business and a low growth business. The point is, at the end of the day, one has to select growth investing in India because India is a growing market. We can't buy a single hotel which will never grow, right? Something like that. But you will buy a business which will grow at more than nominal GDP. The higher the growth, the better, because equity is about growth. But one should not overpay for it. So the term which you would have heard is growth at a reasonable price. What I'm saying is growth should be subset of value. That doesn't mean you buy traditional value stock, you buy growth stock, but at rational valuation. Now, it's slightly more nuanced, and that's where you need more sort of analysis, etc. A 15 P stock can be expensive, and a 40, 50 P stock can be cheap. So it's not necessarily that people say that this is 60p, it is expensive, or new age is sort of expensive because the denominator is less. It's a function of what the growth is and the quality of the growth. For that growth, do you need capital or not? So I think it's slightly more sort of thing. But yeah, I mean, just to get a color of it and what in the sense of the question, that one should not overpay for growth and at the same time hunt for value within growth oriented businesses. I should have a minimum threshold of growth oriented businesses. A 15% growth business can, if it is available cheap, can be much better than a 20% business growth business, which is available expensive. So all those factors are there. The long answer, but I think essentially you have to draw a line on valuation and buy growth oriented businesses.
Thank you so much for that answer. So there's another question, which is basically kind of a mix of couple of things. So you did mention about certain sectors doing really well, housing and couple of other sectors. But if as an investor, we have to really look at, what kind of sectors or what would be the drivers for this, this movement of GDP from 4 trillion and beyond. Or if I look at different sectors or different large caps, what would be like the categories of scheme at this point of time if an investor has to really look, depending upon sectors, depending upon capitalization, or depending on how the GDP moves from here on? I'm
Yeah,
sorry, but it has a couple of things in between.
yeah. So I mean, see, the growth is will be driven by primarily because of the consumption trend, the infrastructure piece. These are the drivers of growth, and then you have no element of manufacturing, etc. But there can always be that what is a growth business need not be a good stock also. I mean, stock selection is slightly different from if it is already priced in or if the character of growth is not good. But coming to the point in terms of you have to capitalize from a longer term, best is to buy diversified sort of funds. And there are various categories which are very interesting. I think, as I mentioned, that categories like large and mid cap or a multi cap have become very much meaningful. Or otherwise, there are advisors like you who can sort of guide it. Eventually, I think 50 to 65% large caps, the remaining half to one third into small and mid caps is a good construct to have from a longer term perspective. That is one. And it's better to always look at diversified thing because rather than looking at only pure sectoral fund, which can be more tactical, core or satellite. A core should be more diversified fund, a multi-cap is good, or a large and mid-cap is good, or segregated, but the similar proportion of funds are sort of well suited. Because what happens is there are always, as I said, certain sectors are doing well, but if they're already priced, then you don't buy that. So it's the flexibility to participate in the growth is much more nuanced in terms of the stock selection, bottom of stock selection. I think diversified multi-cap, I think is if someone were to choose only one category, makes a lot of sense from a 5-10 year perspective because of the relevance of mid caps and small caps.
Thank you so much. I'll just take one last question. So we did touch upon this briefly when we were talking about BFSI, but we see this kind of renewed interest in the PSU sector for that matter. So, I mean, irrespective of which sector they are operating, but across the sector, there's generally this caveat that you can there's a uncertain element wherein a sudden policy change could really kind of change the profits or the margins for these companies. How do you read? Do you really think with their low valuations and with this added risk, they are definitely something to have in the portfolio at this point in time?
Sure. See, when we look at a stock, there are three things: business selection, management, valuation. When you say about PSU, we are referring to the second point, which is management, which is government owned or private. Now, that is one point, but as you rightly said, we say that in general, government companies are good or bad, or stock is good or bad, because it could be in different sectors. The modes could be different. A government company in certain sector could have significant competitive advantage. For example, in utilities, their borrowing cost is very low. So that's a competitive advantage which the private company doesn't have. And they are in fact largest company. So it makes sense there. But that may not be true in services sector. Seldom government companies globally and in India have done well, whether it is hotels, airlines, or so. Similarly, in banking, they have advantage in terms of the liability of the brand or the franchise side. So each is different. But I got your point. Say what happened. This basket was cheap 4 or 5 years back, unusually cheap because it was 10-year beaten down. Because most of these were economy-driven businesses, large economy. I talked about utilities, banking, and all, and they had because the economy and there was coming out of NPAs, etc. So from that very low dollar for 25 cent, it has now moved to closer to whatever a dollar or so. It's been a magnificent run. But that doesn't mean that we compromise on quality of thing. This is one of the factors of the many factors to select stock. There is no clear yes or no government company is good or bad. In certain areas, it is good. And you have to carefully analyze that if there is a sustainable advantage, if there is a moat, in fact, in some cases it is advantage, in some cases it is not advantage. At the same time, that certain companies have moved just because they are in government or in defense or in railways, and also one has to be careful of those categories of companies, which has just moved as a flavor of the season over the last 1 year, and that should be avoided.
Thank you so much for putting it so clearly. So that was basically the last question that we had received towards the webinar today. So I would really like to warmly thank you, sir, for sharing. It's always interesting to have an industry expert because we read so much about the positive data, but how to really extrapolate. We need experts like you to share your views on that thing. And I would also like to thank everyone who has joined for today's call and spared the time to attend the webinar. Thank you, everyone.
Thanks, Nidhi, for inviting, and thank you. Have a good evening.